My name is Nathan Binshtok, and today we are joined by Rob Kaplan as our first guest. Rob Kaplan is Vice Chairman of Goldman Sachs and a member of the Management Committee. Previously, he served as President and CEO of the Federal Reserve Bank of Dallas. Before joining the Fed, he was a Martin Marshall Professor of Management Practice and Senior Associate Dean at Harvard Business School. Now, Rob, I'm here today at the Dole Institute of Politics, which is on the University of Kansas's campus. I understand you have a connection to KU. Could you tell us about that and walk us through your career?
Sure. So I'm from Kansas City. I was born in Kansas City. Went to University of Kansas, grew up in the state of Kansas. And so I obviously have very fond feelings toward University of Kansas and Kansas generally, and I go back regularly. Have been active helping the chancellor, speaking at the business school, speaking at the Dole Institute. And so it's an honor to be speaking here with you at the Dole Institute.
Amazing. Could you start us off kind of back when you were a student at KU? How did you first get involved with Goldman Sachs and end up working at the Fed?
Well, obviously I never heard of Goldman Sachs when I was at KU, and I didn't really ever think about the Fed. So I went to University of Kansas, wound up basically majoring in business, went to Summerfield. It's now called something else, but I think the Kaplan Federal Business School. I took liberal arts classes my first couple of years, English, a whole range of other classes, then majored in business, worked at the summer at KU Med Center, painting addresses on curbs, selling steel siding, odd jobs. And so I first went to work at Pete Marwick in Kansas City out of Kansas. And I worked there for 2 years. I took the CPA exam when I was a senior in college. And then it was after that for 2 years that I went to Harvard Business School. Then after Harvard Business School is when I accepted a job and went to work at Goldman Sachs. I wound up staying at Goldman Sachs for approximately 22 years, ran our Asia business, ran investment banking, then oversaw investment banking and investment management. And I took a leave of absence in the fall of 2005 to teach leadership back at Harvard Business School. And I did that for about 4 months. And I got up the nerve after that leave of absence to go back and resign. And I wound up staying at Harvard Business School for 10 years, first as an instructor, then as professor of management practice, then senior associate dean. And a former client of mine in 2015 was chairman of the Dallas Fed. And they were doing a search for a CEO. He actually didn't call me. He didn't think I was a good candidate. He called me to do a check-in on somebody that they did think was a good candidate. And I gave him a very good check-in. I thought he was a good candidate too, but they didn't hire that person. But he circled back to me a few weeks later and said, would you be interested in this job? And we agreed that it was not a good idea because I didn't have the right background. But he after a couple of days, he asked me to come down and interview anyhow. And I did interview, and the interviews went well, and they wound up offering me the job a few weeks later. And I started at the Dallas Fed in September of 2015. And then I was at the Dallas Fed until basically near the end of 2021.
Okay. Thank you so much. Now, for our specific topic of today's podcast, I want to talk with you about the independence of the Fed. But before we get there, I think it's important to provide a little background for our listeners. Rob, what is the Federal Reserve's mandate and what policy tools do they use to meet it?
So the Fed has a dual mandate in the lingo: full employment and price stability. No, there's not a hard number on what degree of unemployment constitutes full employment. It's a judgment the Fed has to make, but it's always trying to figure out where we basically at or near full employment. At the moment, the unemployment rate is, for example, 4.2, 4.3%. Kind of in the neighborhood of full employment. We got as low as 3.5% pre-COVID. So you could go lower, but that's one part of the mandate. Second part of the mandate is price stability price stability, the Fed has designed it has interpreted that to mean that headline inflation should be running approximately 2% a year. Prices go up 2% a year. Where right now, the inflation rate, for example, right now is closer to 2.75% to 3%. But it's trying to adjust the Fed funds rate, make other decisions regarding its balance sheet with the objective of trying to get to full employment and price stability. And it also is responsible for regulating banks, along with the FDIC and other agencies regulating the banks in the United States.
Great. Now, Rob, you briefly mentioned the Fed funds rate and the Fed's balance sheet. Could we briefly zoom in on those two policy tools and kind of what effects they have and how the Fed uses them?
Yeah. So the Fed funds rate is basically the short-term rate. It is used as a benchmark on where banks borrow from each other. If you look at the rate that banks tend to lend to their customers, used to be LIBOR, now it's something called SOFR, the Secured Overnight Financing Rate. That's usually the midpoint, roughly, of the Fed funds rate. And so it is the short-term rate that prevails in the United States, and it makes a decision on that rate. Now, if unemployment is too high, it might be inclined to cut that rate in order to spur demand for labor. If inflation is running hot, it might be inclined to increase that rate in order to cool demand. And sometimes it's in the awkward position where you're not at full employment and you have an inflation problem, and then it's got to figure out how to balance those two things and set the rate that I likely will try to return you to full employment price, but there's often a trade-off in that judgment.
Absolutely. Now, Rob, is the Federal Reserve a part of the federal government? What's the importance and the history of this distinction?
It's in the lingo, it's independent, but let's explain what it's independent of. It is overseen by Congress. Mm-hmm. So it's not independent of Congress. It is accountable to Congress, but it is independent of the executive branch, even though the executive branch has the ability to appoint, subject to congressional ratification, the governors. But it's independent in that in making decisions around the Federal Open Market Committee table. Federal Open Market Committee is made up of the 12 bank presidents. I was one of the 12 bank presidents, and 7 governors. When it meets every 6 weeks, therefore 8 times a year. And when we go in to try to make a decision on the federal funds rate, I do that without regard to political influence or political considerations. That doesn't mean the Fed is not accountable or answerable. It is, but to Congress, not to the president, not to the executive branch.
Okay, thank you. You briefly mentioned the Federal Open Market Committee and the Board of Governors, and I wanted to talk a little bit about those different moving parts of the Federal Reserve System. So there's that central component, the Board of Governors with those 7 seats you mentioned, but then there's also the regional banks and bank presidents that you mentioned. How does that all kind of fit together? What are the different roles there?
So the 7 governors live in Washington. They are appointed. They are nominated by the President of the United States and have to be approved by the Senate. Mm-hmm. They're in the lingo known as political appointees. One of the 7 is the chair. Mm-hmm. Okay. The other 12 bank presidents are not political appointees. They are recruited and interviewed by the local boards of each of the regional banks. They then have to be approved by the Board of Governors. But the reason I say they're not political, the president did not nominate me. I got interviewed. The board selected me. the board of governors approve their selection, but that's how that process works. The only other comment I'd make, there are lots of differences in the job. If you're a bank president, you run a local bank. I had 1,300 people at the Dallas Fed, run supervision, have a research department, community outreach. The 12 banks work together on payments and other functions of the system. And you have a turn, which is you have 5-year terms and there's mandatory retirement at 65. The Board of Governors, on the other hand, has one, depending on how long it's, I think from start to finish, it's 12 or 14 years. They do not have the same management responsibilities. They tend to divvy up responsibilities among the governors. But so your day-to-day activities are somewhat different.
Okay. And what are the specific roles of each regional bank? How does that factor into both what goes on a national scale? How is that different? And kind of how does the president of any given bank split their attention between those regional concerns and their national role?
So when I was running the Dallas Fed, my first and foremost, my job is to understand Texas and the 12th district, or excuse me, the 11th district, I should say, that is the Federal Reserve Bank of Dallas, and understand the national and the global economy.
Yes.
Okay. In addition, my job is to know the community, be out in the community. It's to oversee and work with our supervisors who supervise the banks, regulate the banks. And then the other thing is there then our nationwide responsibilities. So, for example, I chaired the budgeting committee for the whole reserve system among the 12 banks. I oversaw something called ITOC, the Technology Operating Committee. I chaired that. And so there are certain national system-wide responsibilities that we also each are responsible for. And each of the banks play different roles in the whole federal system. So, for example, if you ever sent a wire transfer or you made electronic payment, different reserve banks play different roles and have different responsibilities in that system, and they work together to execute that system.
Okay. Now, another piece of background that I believe is vital to any discussion of Federal Reserve policy is the current state of the economy. So, Rob, how would you characterize the place we find ourselves today, particularly with respect to factors influencing monetary policy?
So let me just frame, there are structural changes going on in the U.S. economy. What a lot of people, when they read the paper, tend to focus more on is the cyclical changes. Cyclical are things that are happening now. Is employment going up or down? Is inflation up or down? Is business sentiment better or worse? Is the economy growing?
Those business cycle changes?
Yeah. Is GDP going up or down? What's GDP for this quarter? Those are cyclical.
Okay.
Okay. I focus more, and this is a little bit as a former business person, I focus more on structural. What are the demographic trends? What's fiscal policy? What's tariff policy? What's immigration policy? Those are structural. What's education policy? Those are structural changes. Okay. They're fundamental. So what's going on right now in the United States, I would say there are 2 or 3 things that are creating headwinds for the economy, and there's 2 or 3 big tailwinds. Let's mention what they are. The headwinds for the economy are first tariffs, which is a structural initiative, not by the Fed, but by the executive branch and Congress. Tariffs, I would argue, are having some slowing effect on the economy, at least in the near term, maybe having some, upward price pressures, creating some upward price pressures. That's one. Immigration policy, we have shut off lax immigration, but we're also have not clarified the status of 12 to 15 million undocumented workers, not here illegally, but they're on provisional status as to whether they're going to be allowed to stay or not. And what we're hearing across the country, some percentage of those workers are not going to work. They're not sending their kids to school. They're not out. They're not even venturing out. That's a big also headwind for the economy. because many businesses tell us they can't find workers. There's a supply issue, but it affects demand also, reduces demand. The shutdown has been a structural change away from the Fed that it luckily is getting resolved, but that slowed demand. So those are headwinds, and that's why GDP growth in the economy and the labor market feels sluggish, in my opinion. There are three big tailwinds. Tax incentives are coming in January based on the legislation that was just passed. Tax on tips, tax on overtime, accelerated depreciation. There's regulatory reform is coming. It's already started, but it's going to get further along as we get into 2026. Should be a positive for growth. And the third big structural change is the AI data center power boom that is also fueling growth. So what I just described are cross currents. So many people are looking at the week-to-week, month-to-month numbers that are coming out, although there haven't been as many because of the shutdown, but we'll get them again. And they're confused. It's confusing. And it's not surprising that it's confusing because you've got these headwinds I just described, and you've got these tailwinds. It's not a surprise that if you're looking at the data, this would appear confusing.
I wanted to ask you about a few of those headwinds and tailwinds in particular that you mentioned. Firstly, on tariffs, do you think that it's been long enough to see the effects that tariffs have held on the economy, or is there still things that aren't showing up quite in the data?
Yes and yes. It is soon enough to see some of the effects, and there's some effects that have not yet shown up. Okay. So I can tell you big businesses are struggling to figure out their logistics and supply chains and how to be globally competitive. And they're trying to figure out how much of the increased costs they should put in pricing versus come out of margin. And every business I talk to is quietly struggling with that issue. Small businesses, on the other hand, some of them are thinking about they won't be able to stay in business. If you're a soybean farmer in Kansas, this could be life-threatening as to whether you think you're going to continue to get your business, because the markets for your goods, China in particular, have been curtailed. And so I'm seeing that. Those things are showing up now. Some of the price increases have shown up. Some of the price pressures are still in front of us. And then the part that's really not shown up yet is if you believe that many people will increase their investment here and will decide to increase their domestic U.S. manufacturing capability, that should be positive for growth. But I would argue we maybe are not seeing that yet. And there's some question, and businesses I talk to are trying to feel their way on how much of that they're comfortable doing. So that part is a positive. That we're probably seeing the more negative parts to this, not the positive parts. And the positive parts are over the horizon, and we'll have to see how they unfold.
Okay. And another headwind I wanted to speak of briefly, just with the relevancy as of this current date. With the government shutdown, we're recording here on the 17th of November, and a deal has just been reached there. How has that affected monetary policy in terms of the data and what the Fed looks at whenever they're making their decision and meeting with the Federal Open Market Committee? And also, what effects has that had on the broader economy?
So the more important question, the effect on the broader economy is it's had a slowing effect. Mm-hmm. You got sizable number of people that are not getting paid. That's going to slow growth, reduces income. I'm sure it's reduced spending. If then there's the obvious, the air traffic controllers not getting paid and the cancellation of flights, that just is that just reduces growth. Now, the reopening, the idea is, I think that the compensation will get paid in full. Obviously, flights will be restored, so maybe we'll get some, I don't know, maybe we'll get some boost to growth, but there's no question it's slowed growth. It's slowed hiring. For the Fed can see that. It hasn't gotten data from the Commerce Department because the group that produces it hasn't been working. So it's going to start getting data, but it's going to be old and stale, and it's going to take a while to get caught up on the data.
Okay.
But I think even if we're getting data, I don't know that it's going to show us anything too shocking. It's going to show us, I think, that the economy is slowed.
Mm-hmm.
The question is, I don't know. Question is, what do you want to do with that information if you know some of it was due to the shutdown, which is being reversed? That's the question.
I see. With that decision and that kind of question before the Federal Open Market Committee in their next meeting in December, how would you describe the current policy stance of the Federal Reserve with respect to the federal funds rate and its balance sheet and policy tools?
Yeah, I would say mildly restrictive.
Mm-hmm.
So it's wonky, it's imprecise, it's a judgment, but you got to still try to figure out what the neutral rate is.
Mm-hmm.
Are you being accommodative? I mean, stimulative? Or are you being restrictive, which is, i.e., slowing growth? You got to have a judgment where you are. My own judgment where we are, if inflation is running 2 3/4 to 3, and I personally think the real Fed funds rate, neutral Fed funds rate, is 0.75% to 1. Okay. That means the nominal neutral rate to me, I have a hard time arguing it's lower than 3.5, 3 3/4. The Fed funds rate right now is 3 3/4 to 4. It's just 25 basis points or, plus or minus 25 basis points, I would guess, above neutral, not very restrictive. Why does that matter? If you think the labor market's weakening, you might be glad to get to neutral. Okay. However, if you think that tax incentives, regulatory reform, the AI data center power boom is going to continue to where the economy is going to firm in the next year, you might not feel as strongly you want to be at neutral. At the same time, inflation is running 2 3/4 to 3. The Fed's target is 2. You certainly, based on inflation, you definitely don't want to be at neutral. Okay, you want to be above neutral.
Mm-hmm.
So that's why they're struggling to try to really understand where's the labor market and what are the prospects for inflation. And that's why they're very hesitant to do another rate cut in December. That doesn't mean they won't do another rate cut, but they're struggling with that decision. And I would be too.
Mm-hmm. So with all that context on the role of the Federal Reserve, the current state of the economy, and the decisions before the Federal Open Market Committee, I want to move on to our conversation on Fed independence. Rob, could you start us out? What is the history of Federal Reserve independence in the United States, and how has that evolved over time?
I can give you the last 50 years history.
I'm not sure if we quite have time for that, but just maybe some highlights.
No, but what I mean is, I'm making a different point, is a lot of people go back and talk about the history over the last 100 years. 50 years is pretty recent. And my point is, the last 50 years, Fed on setting on the Fed funds rate has been relatively politically independent. That doesn't mean there hasn't been criticisms, and whether it's President Johnson or other presidents put pressure on Fed, that's happened. But by and large, I think the understanding is that monetary policy, particularly the Fed funds rate, is going to be politically independent. The balance sheet, the Fed's use of its balance sheet is pretty recent development in the last 20 years.
Yes.
With the great financial crisis. And I think that's a little more gray as to how much coordination there might be between the Fed and the executive branch on use of the balance sheet. But by and large, the Fed, I think, currently in their minds think they're politically independent on that also. That could get debated again. And on regulation, the Fed has not been politically independent for some time. When there's a new administration, they change regulatory approaches, and nobody seems to find that objectionable.
Are there any particular case studies that we can look towards about central banks losing their independence, or the effects that may or may not hold, both inside, outside of the United States?
There's lots of case studies. However, the punchline of those case studies, and you'll hear this refrain, is is countries do much better when they have a politically independent central bank, because it gives confidence to external stakeholders, internal stakeholders, that you have a body that will do what needs to be done, even though it's unpopular, to control inflation and produce, full employment. And sometimes what the Fed has to do is not popular, and it needs to be insulated. And so I think you'll hear many people, and I agree with this, say the mark of a successful country is an independent central bank.
Absolutely. Now, one thing I think is important to look at is any ways that monetary policy and the fiscal policy of the federal government are inextricably linked, or ways that they're forced to interact no matter what. So one example that comes to mind are interest payments on the national debt. Are there any other areas in which this is the case? And what do you think the importance of that connection is, and how to retain independence with those connections?
Let's put it a different way. Monetary policy, I've regularly said, is a piece of a larger puzzle of economic policy. So what are examples of other economic policies? Fiscal policy, spending, taxes, education policy, immigration policy, tariff policy, regulatory policy. I could go on and on. Environmental policy. There are a whole range of policies that affect economic growth. The Fed funds rate and the Fed balance sheet is a piece of that broader puzzle. And a reason I say this, people sometimes forget that. So, for example, if inflation's running hot in 21 or 22, in my opinion, part of it was the Fed was too accommodative, but the other part of it, we spent an enormous amount fiscally. We ran up the deficit from the mid-70s as a percent of GDP to 100%, roughly speaking, by excess fiscal spending that I would argue overheated the economy, and the Fed did not adjust. Fed was also aggressive with monetary policy. It was too much. And so the inflation issue began as a supply chain logistics issue. It morphed, in my opinion, into an excess demand issue. So if you're going to be setting monetary policy, you've got to be very aware that you are a piece of the puzzle. It would be a mistake for people to think, oh, gee, inflation's hot, it's all the Fed. It's not all the Fed. If you want inflation to come down, the Fed cannot do it, in my opinion. It can't do it as easily all by itself. You need a whole of government approach. And I think sometimes we forget that.
Now, with that whole of government approach, and this is something you briefly touched on earlier, what kind of oversight does the federal government have over the Federal Reserve?
Well, it gives regular congressional testimony. I think so far what it's been is, the Fed reports and congressional and Senate and House in hearings ask questions. They have up to now been reluctant to do more than that, i.e. they're not directing the Fed. And most congressmen and senators have been careful about how they direct the Fed on what decisions it makes, and they've respected that independence. But that doesn't keep them from asking questions and prodding. And at times could, saying, gee, I really wish you'd do X, Y, or Z, but there's a limit to how far they go with that. Also, when the president nominates a governor, the Senate has to approve that governor. So in that regard, they have meaningful power.
Yeah, that kind of oversight between different aspects of the government, definitely.
Mm-hmm.
Now, Rob, I do want to ask you to engage in a bit of a hypothetical. How could lessened independence affect the Fed's policy tools and their dual mandate?
Well, I mean, if the Fed is under great political pressure and the leaders think they're going to get replaced if they don't make decisions, they're more like cabinet officers. You can be replaced at the will of the president at any time, or you're worried about that. and you want to please the executive branch, you might either lower rates more than you would have otherwise, or you might raise them more than you would have otherwise. I think the bigger worry is probably that you lower them more. Most presidents want lower rates. They want higher growth. They want lower rates. Economy's going to do better with rates are lower. Problem is inflation may be higher too, but presidents like economic growth. And the danger is you could see if people don't have as much confidence that the Fed is going to be vigilant to keep inflation from becoming excessive. You see the dollar weaken. You could see gold go up a lot. You could see people more reluctant to own the 10-year Treasury. And you may be seeing some of those things right now. It's hard to tell. Listen, it's hard to tell why markets do what they do, but it's possible some of that is concern about over the next couple of years about independence of the Fed.
How would that affect how we look at kind of the short-term versus long-term trade-offs? Is it a valid characterization that the fiscal policy or maybe some of the pressure from that area may be more in kind of the short run and the short term, while the monetary policy looks at the bigger picture here? Or how would you describe that?
If people don't have confidence in monetary policy, again, weaker dollar, all things being equal, maybe higher interest rates. People demand higher rates. That's a now thing. That's not a someday thing. That's now. Means deficits could be higher. Could be, on the other hand, nominal growth is higher too, because the Fed funds rate's too low. So you'll see it in the economy. You see normally you say monetary policy acts with a long lag, and that's true. But you'll see the effects of it.
Okay. Now, my last question in regards to Fed independence is the potential increasing trend of disagreement between voting members of the FOMC. So, for example, the meeting this past July held 2 dissenting votes, which is the first time this has occurred since 1993. What are your impressions here, and do you think this is a cause for concern?
No. I think it's better if there's debate and disagreement. I don't think it's a bad sign that there's debate and disagreement, as long as the people debating and disagreeing are doing it based on their legitimate views. I would not want to see dissents and debate and disagreement if I think somebody is carrying water for, a political party or a political force or because of political influence. But assuming that people are legitimately articulating their strongly held views, I think debate and disagreement's better. I think you make better decisions. So I'm not really scared of that. And I don't know that it's a trend. I'm not sure, whether it's a trend or not. I don't know. We'll see. I understand why they're debating and disagreeing right now. I would be, I know what I'd be debating. And it's this issue where we're at or near full employment, but the labor market looks sluggish, weak. At the same time, inflation's running above target. And that's a remedial tax, regressive tax on 85 million people in this country that work, that make 55 grand a year or less and can't make ends meet. There's good reason to be agonizing and debating right now.
So it's more of a function of those headwinds and those tailwinds that
I think it's a function.
Now.
Yes, it's a function of the situation. There are times where I think it's not perfect, but I got a pretty good idea within a range what we ought to be doing on monetary policy. This is one of those periods where I think we're getting to the point where it's a tougher call. And at transition points, it usually is a tougher call. I think we're probably at a transition point here.
Okay, thank you. Now, I want to round off today's discussion with a little reflection. Many of the people listening to this podcast are likely to be students at the University of Kansas and also members of our student advisory board here at the Dole Institute. Rob, you're someone who has taught and written extensively about leadership. What advice do you have for current college students or those looking for careers in leadership?
So, first of all, leadership to me is thinking and acting like an owner in a way that adds value to others. Think and act like an owner. So we just got done talking to the Fed. What I'm saying is I want those folks around the table. They can have all sorts of views. That's fine with me. But when they're coming up with them, they better be thinking and acting as if this is my decision, our country, and I want to do it in a way that adds value to society. That's the mission for the people listening, for the students. Now, how do you do that? First of all, it takes experience, it takes practice. And I would say for most of you listening, if you're a student, you're about to start your first job or think about that, you need to do a couple other things about managing yourself. One, what are your strengths and weaknesses? Can you write down, or do you have a good grip on what you love, what you're good at, I should say, and what you're not good at? And you may have to, are you willing to take advice from people who observe you? You may think you're great at something, but people who observe you don't think you're as great as you think you are. You got to learn to seek advice and have a good grip. Second, what do you have a passion for? You're going to be far more successful doing something where you have a passion for the mission, the task, the people, enough elements. A lot of people say, well, I should take a job that pays the most money, right? No. My experience is I see a lot of people do that. It's usually a terrible decision. I think you're better off taking a job where it's a fit for your strengths and weaknesses, and you have a passion for what they do. They think they're going to teach you. Making money is something that happens over 15, 20 years. It doesn't happen over 6 months. If you do not like what you're doing, I don't care how much money they're paying you, you're never going to last long enough to do well and to develop your skills. Many jobs, especially today, are experience-based. You won't be able to stand to do it for longer than 18 months. You're never going to get the experience to get the benefit of the job. Pick things to do where you believe you can stay with it for years. You may not, but at least try to pick something where you can stay with it. And I think you're going to develop much, much more, and you're going to have a much more successful career. When you get into that job, the thinking and acting like an owner is what I'm looking for in a younger person. Once somebody can do the job, is reliable, I don't expect them to know everything. We're going to have to teach them, but I want them to have a mindset where they look to help others. Treat this as if it's their business, even though it's not yet their business. Act like you're an owner, and that's what I'm looking for in somebody coming out of school.
Okay. Now, one thing you mentioned is finding something that you're passionate about and that you have an aptitude for. But those two things don't always align, at least right away.
They don't.
How do you think it can be best to balance those things? You might be very, very good at something and not passionate about it, or you might be very kind of vice versa. Like maybe I'd love to be in a band. Can I play an instrument?
Yeah, but my experience is people are funny. Ultimately, if you're not having success, my guess is you're going to lose your zeal for what you're doing.
Mm-hmm.
People like positive reinforcement.
Mm-hmm.
If you're doing something and it doesn't go well, you're struggling with it, my guess is you're going to run out of gas. So it's got to be where there's got to be enough parts of the job that you're good at. I don't mind if there's parts you're not good at, but if there's enough parts that you are good at and you have a passion, then you'll figure out how to manage around your weaknesses. But my experience is people usually run out of steam if they think they're going to love it, but they just cannot master any part of it. They don't develop strengths vis-a-vis that job. I think you're going to likely find you're going to run out of gas. So it's got to be a match. Strengths, weaknesses, passions, not perfect, but some matching is, I think you're going to find is important. And you might have to do 2 or 3 jobs to figure that out. What I don't want you to do is be somebody who just bolts every 2 or 3 years, because you're going to have to find something that ultimately you're going to stay with, in my opinion, for 15, 20 years. That should be your aspiration. If you think you're going to make a huge success by quitting, rotating every 18 months, I think that's an exhausting way to do it, in my experience.
Well, Rob, that is all the time we have here today. thank you so much for joining us, especially as our first podcast guest. The
Good to
same
talk
goes
to you.
for our listeners. I really hope you enjoyed today's episode, and I will be seeing you next time from the balcony.